Welcome back to Factful Finance, where we dive deep into the numbers that matter most to your financial success. Now, let me ask you something. Have you ever wondered whether it's a good idea to exercise your stock options early? The decision could cost you, or it could save you, depending on how you approach it. Today, we're going to break down the tax consequences, the pros and cons, and what might be the best strategy for your situation. Stick around, because by the end of this video, you'll have a clear understanding of how to make the most out of your stock options. Before we dive in, quick disclaimer. The information in this video is for educational purposes only. Please consult with a tax professional or financial advisor to tailor this advice to your personal situation. All right, let's get into it. Stock options, whether they're part of your compensation package or an investment opportunity, can be a great way to build wealth. But the question remains, should you exercise them early? The answer depends on several factors, and today, we'll focus on the tax implications, which can really make or break the deal. First, let's talk about what happens when you exercise stock options. Stock options typically come in two flavors: incentive stock options, ISOs, and non-qualified stock options, NSOs. The tax treatment is different for each, so knowing which one you have is essential before making any moves. If you exercise incentive stock options, you won't trigger ordinary income tax at the time of exercise. Sounds great, right? However, there's a catch. The value of the stock at the time of exercise can trigger the alternative minimum tax, AMT, which could significantly affect your tax bill. And if you sell the stock within a year of exercising, you'll also lose the favorable long-term capital gains rate and will face short-term capital gains taxes instead. On the other hand, non-qualified stock options, NSOs, are taxed differently. When you exercise NSOs, you'll pay ordinary income tax on the difference between the exercise price and the fair market value of the stock at that time. This amount is considered wages and will be subject to payroll taxes as well. The upside, when you sell the stock later, you'll pay capital gains taxes, assuming you've held it long enough. Now, should you exercise early? Here's where it gets nuanced. The general rule is that exercising early makes sense if you believe the stock price is going to rise significantly over time. By locking in a lower exercise price, you stand to benefit from future appreciation. However, the earlier you exercise, the higher the immediate tax burden, especially if you have NSOs. You'll need to pay taxes on the difference between the exercise price and the current market value, even if you don't sell the stock right away. Let's say you work at a tech company, and you've been granted 1,000 NSOs with an exercise price of $10 per share. The stock price is currently $20 per share. If you exercise today, you'll have to pay ordinary income tax on the $10 difference per share, or $10,000 total. Plus, you'll pay payroll taxes on that amount. If you wait to exercise and the stock price rises to $50, your tax burden increases substantially, since the spread between the exercise price and the market value is now larger. However, if you're dealing with ISOs, the situation is a bit more complex, but also potentially more advantageous. If you wait to exercise, you might qualify for long-term capital gains tax rates instead of paying ordinary income tax, which is much lower. But remember, the AMT could apply to your exercise, and if you're not careful, you could find yourself owing taxes that you weren't expecting. A key factor in deciding whether to exercise early is understanding your cash flow. Exercising stock options requires capital upfront. Are you prepared to pay the taxes now, or would it make more sense to wait and possibly sell your options when the stock has appreciated? To help visualize this, consider the case of John, a software engineer at a fast-growing startup. He's been granted 5,000 ISOs with a strike price of $10 per share. The company's stock is currently at $15, but he believes it will hit $50 in 5 years. If John exercises early, he could lock in that $10 price, but he would need to pay AMT on the difference between the $10 strike price and the market value at the time of exercise. If the stock increases in value over the years, John could potentially sell it at long-term capital gains rates, significantly reducing his tax burden. But let's also consider Emma, a marketing manager at a large company with a more stable stock price. She has 3,000 NSOs with a $5 strike price. The stock is currently at $25, and she's unsure about the company's future growth. In her case, exercising now would trigger a significant tax bill on $60,000 of income, and that's not counting the payroll taxes. She may decide to hold off on exercising until she has a better sense of where the stock is headed, or she might decide to sell the stock soon after exercising to avoid the risk of the stock price declining. In both cases, tax strategy plays a major role in determining whether to exercise early. And here's the bottom line. Exercising stock options early can be beneficial, but it requires careful consideration of your current tax situation, future expectations for the company's stock price, and your personal financial situation. So, should you exercise stock options early? It depends, but generally, if you have ISOs and a long-term optimistic outlook on the stock, early exercise might make sense. For NSOs, the immediate tax burden can be more significant, and it might be smarter to wait until the stock price appreciates further. However, regardless of the type of stock option, always consult a financial advisor or tax professional to understand the best strategy for your unique situation. What's your next step in managing your stock options? Let us know in the comments. We'd love to hear your thoughts. Thanks for watching Factful Finance. If you found this video helpful, consider giving it a like, subscribing, and clicking the bell so you never miss out on the latest financial tips and insights. We think you'll find the next video helpful as you navigate the world of stock options and taxes.